Welcome everybody to the IFM diversification webinar. We're going to be taking a quick look at a couple of products we have available here at IFM to give clients the opportunity to diversify their portfolio into different asset classes, and even if it's within the same asset class, a different style of trading to give yourself a different exposure to the market. So let's take a quick look. As always, general advice only. Trading does involve risk. Past performance is no reliable indicator of future results. If you'd like any more information about the products and services that are offered here at IFM, don't hesitate to give us a call here on the desk and have a chat, or you can access all of this via our website at intelligentfinancialmarkets.com. Let's go straight into it. If we take a look at portfolio products, so what I'm going to do here is just give you guys a quick overview of 3 different products we have available for portfolio. A basic allocation rule you could, use as a guide. Definitely wouldn't apply to your personal circumstances. And I suppose get your mind thinking about, well, what accounts do I have with IFM or with another broker or with whoever, or what am I doing with my other assets? How am I allocating them? How am I spreading them out? What are some good ideas? What are other people doing? Here's a couple of introductory ideas and things we do and things we think we do pretty well. So Atlas Equities. Atlas Equities is an equity portfolio that's headed up by our head of equities here, Daniel Norton, who I'll introduce in a slide in just a moment. It's a portfolio strategy geared towards long-term results. So when I say geared towards long-term results, quite often we find ourselves being caught in the trap of long-term being a month and short-term being a day. If we took that approach to anything in life, we'd find that we didn't really get anything done. Or anything to be incredibly satisfying. So the best things normally happen longer term. They're the most rewarding, and it's the same with equity strategy. Equities need to be approached longer term. That's the way we do it. We do this via mathematical formulas. They're all quantitative strategies. We're going to go through that in just a moment. Automated execution is how we do that. This involves very little involvement from the client. The client is absolutely informed of all trades being executed on their account. We do this via automated execution, which means there's very little input required from the client. Our target zone here is 15 to 25% annualized, so we're not looking to make huge returns here. We're looking to make consistent profits from beginning to the end of the year. We're looking at an annual time frame here, definitely not week or month. Atlas Equities, and where the bulk of your portfolio would generally be according to a general rule. Let's take a look at Olympus, directional currency strategy, automated execution, target zone, also the same, 15 to 25% annually. Always look at these two in an annual way. Never look at them from a day, a week, a month. You will drive yourself crazy. It would be the same as buying a house and every day calling out someone to do an evaluation on your property price. Would you do it? Absolutely not. Would you sell your house if you read the Sydney Morning Herald and it told you house prices were down 2% for the month? Would you do that? Absolutely not. And it's the same thing here. We look at this in an annual, from an annual perspective, and that's how we tend to get stronger results. Quantitative model also built using a mathematical model. Using different formulas here, and that gives us our annualized returns here. iGrid, this is something where we give the clients the opportunity to look at something day in, day out and annoy us with it, and that's absolutely fine because it's there for them to play with. It's a counter-trend FX strategy. It's aggressive. The target zone on this one is 3 to 7% monthly. Highlighted in bold and underlined on small allocation of portfolio. This is aggressive, 3 to 7% a month. The market is not an ATM. If you're starting to treat it like an ATM, I'm sure it's going to turn around and drag the whip out on you at any time. And that's generally what happens. We all know this from our trading experiences. When something feels like it's too good to be true in the market, or it's a sure thing, you get a reminder from the market that it was. And never take returns for granted. So 3 to 7% monthly. We have ways we go about managing all of this, and one of those ways is by making it a very small allocation of the portfolio. We're going to go through that all in just a moment. Atlas. Quantitative Strategies Automated Execution Services aims to deliver outperformance and capital growth. Outperformance means if the Aussie market returns or the ASX returns 10% this year, we're looking to make 13 or 14%. That's outperformance. Outperformance is definitely not outperformance based on the expectations of a client, which may be unrealistic, or ourselves, which may be unrealistic. We're looking at the market. We're going to peg our performance based on that. If the market's down 10% for the year and we turn you a 2% profit, we expect a bottle of wine at the end of the year. And also, if the market's at 10, we're at 15, great. If the market's at 15, we're at 25. We've done fantastically. If we say, well, the market was down 10, you returned at 2, I should have had my money in the bank. Well, you never had a chance at making 25 when your money was in the bank, and that's the way we tend to view this. It's risk on reward, and we try to manage that risk as best as we can in order to achieve a better, longer-term result. All strategies are completely defined, leaving no room for influence from external oversight. These strategies are all well thought out, well executed. The homework has been done here. Nothing is perfect. Nothing will ever deliver according to exactly what we had back tested or seen historically. The reason why we do run our historical back testing and draw up our results and put a basic idea on a walk forward together is because we're trying to lower probability here and give ourselves the best possible view or foresight into the future in order to manage our expectations of results and to best manage our money and risk here. We use proprietary and third-party technology to perform complex mathematical analysis to ensure our strategies are at the market and not behind it. We do not go about trying to put together all components in order to achieve our outcomes, such as when you buy an Apple iPhone, you're buying a phone designed by Apple with the components of everybody else and their software. Very much the same for us. So we'll take other external hardware and technology, we'll use that, and quite often what you'll find with other people, and this is technology and hardware that's widely available to the retail market, you'll find that it's all about how this is used and interpreted. So most people don't know they have institutional resources available to them at a retail level, but using this is complex within itself, and it does require great expertise and skill, and then further that, interpreting what this data is telling you is another thing altogether. So all of our models are built, they're ran, they're broken down further, they're broken down further until we can't break them anymore. That's how we build these models. So to ensure our strategies are at the market, not behind the market. And we're going to go through, we run seminars on these strategies in quantitative analytics. We've got one coming up here in Melbourne. Anyone is invited at no cost. We simply want to get everyone in the room so we can keep in touch with everybody. So please come along. We also give models out at these seminars, and these are working models. These do not have a prerequisite that you do have a brokerage account open with us. We simply feel that you would have one open with us longer term if you were happy with what you were seeing at our seminars. We use proprietary, so I've been through that. Very light leverage is applied, making it ideal for longer term equity clients. So clients looking at longer term results. When we're looking at longer term results, we generally aren't applying large leverage. When we apply large leverage, we run into trouble because we get short term shocks in the market, and if we're highly leveraged, 4 to 1, for example, for every $1 the market moves, your account moves 4. So that can put you in a spot of trouble very quickly. Lightly leveraged, longer term, we're not looking to break records, we're looking to beat the market here. This would be ideal for self-managed super funds and so forth. So if you're managing a self-managed super fund, a family trust, or a large personal account, this is a suitable product. Please also keep this in mind. IFM does not give general or personal advice. In respect to personal advice regarding portfolio allocation, such as for self-managed superannuation, you should not consider this presentation as a recommendation or any type of advice. You should seek competent financial planning advice from an accredited and licensed financial planner before making a decision regarding the allocation of personal funds. I cannot reiterate that more. Everyone has a different situation, and your planner or accountant would probably know a lot more about that situation than us. These are basic ideas and things for you to go away and have a think about the way you're applying your strategy to your portfolio. If we can complement this, by all means, come and have a chat with us. We'd like to think we could work together. Atlas portfolio benefits. General consensus that Australian equities will rise through 2014. We see that Aussie dollar coming down to about 80 cents. That's going to be great for the competitiveness of our Aussie companies working abroad. Great for the competitiveness of our Aussie companies that are selling products in the Australian market that have got to compete with foreign companies, because now the Aussie products are cheaper, the offshore ones are more expensive. Great for Aussie products, Aussie companies that are generating a large amount of revenue offshore. Now when they're bringing those dollars home, they translate in a larger amount of Australian dollars, so the balance sheets look much better, etc. It's great for the Aussie market, and we think that Aussie market's been in a range for about around 5 years now. In the last 8 months, it's really started to take off. Our portfolio is doing really well, and we think it's going to continue to do very well. I invite everyone to ask us what we're holding in that portfolio. I generally mail that out to everybody so they can see what positions we have also. Aussie denominated, investing in ASX listed stocks. So all of our stocks are in the ASX, no currency risk here for our clients. So once again, a great product for trust, self-managed superannuation, and so forth. IFM has appointed ex-institutional trader Daniel Norton to manage the portfolio of quantitative strategies. Daniel managed the technological side of the high frequency trading desk at BBY here in Melbourne. He has a wealth of experience building quantitative models. He regularly runs seminars and so forth, talking about his experience and how I think people can draw from his experiences. Also, he's been doing this for over 10 years now, so we can all learn a lot from Daniel. Daniel is also running an educational seminar free of charge to all IFM clients and guests here in Melbourne in the second week of February. So if you'd like some more information on that, we do invite you to give us a call and book a seat for that, and we'll be more than happy to have you come along. Low leverage strategy, well suited to equity portfolios. As I said, we don't regularly move beyond cash. Cash is the norm. We might use all cash available in the account, up to 2 times at an absolute max. We like to keep it as low around cash level if we can. If the opportunity is there and it's available, we will take it. We'll pounce on that opportunity and apply light leverage, but it's very rare that we do so. At the moment, we're running at about 0.8% of cash available in accounts. So we're not even, 80%, of cash available in accounts. We're not even utilizing all cash available, and that's simply because we see a little bit more downside in Aussie markets. The Aussie market, before it kicks into gear again, we're looking for about a target of about 4,900 before it starts to move higher. So that presents a good opportunity to do some buying, bring down that average buy price of what we're holding in the portfolio for the moment, make back any losses we may have accumulated in the last months a lot quicker, and our risk management has been much more prudent in this particular case also. Portfolio has a number of strategies to cater to varying market conditions. So we have a long model, a short model, a range-bound model, mean reversion model. If we're moving too far away from our average prices, we'll buy and sell back to that average price level of the past period. It could be a 15, 30 or 60-day period. We're happy to share those models, and we're going to attach the documents for those models to this email that will go out to clients. Strict risk management focused on capital preservation. So as I went through before, we're running at 80% cash used in the accounts at the moment, not even at 100% of cash tied up in equities. When we feel the time is right, we will apply that cash to the market and put it out in the market, looking to take advantage. The target return, 20 to 25% annually. That is our target. Sometimes we will go higher, sometimes we will go lower. As I went through earlier, if the market does negative 5% for the year and we're up 2%, we've had a great year. If the market does 10 and we do 18, we've had a fantastic year. If the market does 20% and we've done 35, we've had a blitzing year. That's always our target, so keep that in mind. Performance-focused remuneration. So the way that works is we have our 2% of funds under management and 20% of trading profits with a high watermark quarterly, which means, if we lose 5% this quarter, no performance bonus. If we make 10% next quarter, we're going to take a performance bonus based on 5% of gains in your portfolio. So we would take 20% of the 5%. We don't, lose you money all year round and then make you 30% one quarter and book profits based on that. No, it's watermarked quarterly. So keep that in mind. If you would like the fee structure, we do invite you to review our equities Atlas equities portfolio for a full run through of remuneration. Risks. Market risk. We can't avoid this. So as I said before, if the market's down 10%, it's down 10%. There's risk associated with all of this. If you say, well, Mark, you've lost me 2% for the year. I may have lost you a couple of percent. We may have lost you 5% for the year. But we also, the opportunity was there to make 25, 30% for the year, which the bank couldn't offer you. It gave you 4% for the year or 3%. That's fantastic. But, that risk is what we're taking on in order to get that return. Our target is 20 to 25%. The market is a variable that's beyond our control, but we have our risk management strategies in order to try and contain that downside risk as much as possible. And we do a fairly good job of that with our equities portfolio, so do take note of that. Company-specific risk. Our regulators do a fairly good job of regulating our publicly listed companies, and the ASX is also a very transparent index, and at times there's going to be company risk that's beyond control. It might be beyond control of the company as well. Their suppliers, their customers could have unforeseen things happen to them, and therefore that risk is always there. It's company risk. And once again, when you're picking up these equities, if you buy Telstra, there's obvious company risk associated with Telstra. It could be contracts regarding the NBN. It could be some suppliers to them, or certain customers falling out of favour with Telstra. These always exist. Coca-Cola, another example. No matter how big or small the company is, we always have company-specific risk, such as it would be applied to the housing market, where there is real estate market risk that's applied there, or industry risk at large that it's beyond our control, and that could be associated with what's happening in the employment market, the interest rates being set by the RBA, and so forth. Different variables. Leverage risk. As I said, we rarely move into leverage, but when we do, that risk is there. If we're at 2 times cash, for every $2 or every $1, the portfolio might move. That'll be $2 on your account. So just keep that in mind. Strategy risk. With everything, nothing is perfect. The mathematics on our strategy is fairly poignant. They're never going to be perfect, and the application of them can never be absolutely perfect, because that's the way the market operates. We build models factoring in all these different variables, and we try to give ourselves roundabout figures. IFM grid. Strategy overview. This is a fairly aggressive strategy. The iGrid portfolio is a combination of several unique grid strategies, or grid trading strategies, that each trade one particular currency pairs in one particular direction. If the market moves in the direction of the strategy, then the strategy continues to take profits on the trades. Now, here's the big part for the grid strategy. If the market moves against the direction, if I buy and the market moves against me, if it moves against the direction of the trading strategy, it scales into multiple positions, therefore averaging the entry price closer to the current market price. If I buy the Australian dollar at 88 cents and it falls to 87.50, I buy more. My average price is now 87.75. If the market falls to 87 and I buy more at 87, my average price is now 87.50. Okay, my average price has come down, but I'm also holding more currency. I have a lot more exposure. If I keep doing this down to 86.50, 86, 85.50, so on, so on, so on, I'm creating more exposure and I'm building into a much bigger loss. More exposure, bigger losses. At some point, I will run out of money. My pockets are only so deep. This is the greatest risk with a gridding strategy. Now, even though the probability of this happening is very low, it does happen, and it will happen a couple of times a year. How does iGrid compare with other grid strategies? Well, iGrid has built-in risk controls that control the risk on the whole account rather than individual strategies, which can result in exponentially higher than expected losses. Now, how do I summarize that? Other gridding strategies might have, 5 pairs or currency pairs in their portfolio, each with 10% risk attached to them. If there is a huge move in the market, all 5 pairs draw down, that's a 50% loss in your portfolio. It could be 10 pairs with a 10%, that's your entire account gone. We have a 20% rule that applies at an absolute max to ours, which automatically closes your account down. Designed for day traders who seek to take advantage of volatile movement in the FX market. This is a benefit. Target zone 4 to 7% a month. This is an aggressive return. This is treating the market like an ATM. When we have these kinds of returns, we're taking on large risk as well. And as I said, I'd expect that to happen a couple of times a year. But if for 8 months of the year we're making 5%, that gives us 40%. And 2 of those months we have, and 4 of those months we have drawdowns. That's going to put us at break even. If 8 of those months we return at 6 or 7%, or even if we have 4 drawdowns, we've still made a return for the year. So you have to manage this. You need to periodically remove profits from your account, and always make sure that you're not overexposed in this particular product category. No setup or subscription fees. We don't charge monthly subscriptions. We don't charge a $500 setup or any of this stuff to get your gridding account happening or your martingale strategy happening. And that's simply because it's going to start eating into your returns. And now when we have to build in the expectation of drawdown, now no one can ever sell you this strategy with no drawdown built in as an expectation. They would be lying as a provider, and they would be doing you a disservice. So always keep that in mind. Small capital requirement. Due to the leverage in FX markets, this is a highly leveraged product. So you can get started with a very small amount of capital. And here it is. We have a mini, a standard, and full. Varying levels of risk, varying levels of return. If you look at the month there, the mini average return 4.2, standard 12.6, full 7.6. Full has the lowest risk per drawdown, that is. Keep in mind, we can have multiple drawdowns per year, but it is a very aggressive return profile. Keep that in mind. Risks. Grid strategies are built using the principle of negative expectation. As I went through, I've gone through various webinars with Olympus, which is our other trading strategy we'll go through in a moment. If I'm risking 30% or even 10 or 20% of my account to make 1 or 2% on a trade, it's a negatively skewed trade. My risk is always greater than my reward, therefore my expectation is always negative. Always keep this in mind. It's fool's gold if you look at it in some respects. If you or take a look at some good examples of how we could correlate this with equity markets and so forth. Your risk is always greater than your reward, as I just discussed. Losses can be as high as 20% across the portfolio, and it can happen more than once in a year. Note, martingale strategies are aggressive, or gridding strategies are aggressive, and carry large risk-reward ratios and should not be promoted as an ideal investment product. Asset allocation should be kept to a small portion of your portfolio and profits removed periodically. So a good way to, I suppose, draw a comparison with, say, an equity market. You wouldn't take your entire portfolio and put 100% of that. If you had $500,000 in that portfolio, you wouldn't put $500,000 into a resource stock which has the potential of getting a tenancy license for a prospective site in New South Wales, a coal mine or something like this. And if that's approved, if they get that license, they are going, there's the potential for you to make 1,000% here on $500,000. That is a good example of an FX strategy a comparative FX strategy. We're looking at something here that gives us very aggressive returns. With that becomes aggressive risk as well. So just keep that in mind. We're not advocating you put your entire portfolio into this. It's very common. It's extremely common that people have an aggressive component of their portfolio allocated, and it might be 5, 10%, it might be 3%, 2%, I'm not sure. It all depends on a personal situation. It might be greater. Personally, for myself, it wouldn't be greater than that, 10%. Keep that in mind. Don't buy as an investment product. It's a very aggressive component, and it needs to be traded that way and respected in that sense. Olympus, directional trading strategy, and that should be geared towards a long-term focus, 6 to 12 months. So that's a typo there. Directional trading strategy geared towards a long-term focus, 6 to 12 months. Built using quantitative analytics. Model to trade both sides of the market, so it takes long and short positions. Tight risk controls. Portfolio of currency. So we trade across 7 currency pairs here. It trades, and we'll go through those in just a moment. So longer term outlook, same as equities. We're looking for a 6 to 12 month outlook here. Do not look at something like this from 1 day, 2 day, 1 week, 1 month. You will drive yourself insane waiting for it to make a move. It's very lightly leveraged. It only ever leverages at a max of 2.1 to 1 time of cash, and that rarely occurs. It's generally sitting around the cash level. We do have leverage options available to clients if they would like them applied to their account, but as the standard version, it's very lightly leveraged. We're looking at longer term results here. As I said, 6 to 12 months as an absolute minimum, with a fairly large amount of patience apply there, because if you expect essentially the market to do it, or the monkey to do a trick for you, and you get an instantaneous result, which could be positive or negative, you are going to need to take on a larger amount of risk there. So keep that in mind, and that is Olympus. Directional trading strategy, lightly leveraged, trading both sides of the market. It does oscillate, it is cyclical, so you could have 5, 6 down months for the year, and they might be 1 or 2% of an absolute max there, until the strategy finally kicks into gear. So each pair is equally weighted. And here is the performance of each pair over a large period of time. If you look at, say, the Aussie Chief, which is in the red at the bottom there, that's severely underperformed. We could take a look at the Euro Aussie, which sits at the top there. Now, the Euro Aussie might be much more volatile, and its losses were far greater than the losses on the Aussie Chief over that period of time. So in order to balance the portfolio, the Aussie Chief gave us very consistent conservative profits over that entire time, and it also gave us a very tight risk to reward ratio. So the risk was tight the whole time, therefore it was a good component for the portfolio. It wasn't the best performer. Why don't we just double up on all the top 3? And that's because we want to balance the portfolio. Benefits. Low leverage FX strategy, which equates to lower volatility, as I just went to before. The leverage is low, and we keep it that way. We're looking at a longer term outcome here. Targeted consistent long-term results of 15 to 30%. We want to see this annualized longer term. Drawdowns are slowly built into over long periods. A drawdown could be built into over 3 months. The largest one we've had so far was 6.82% of historical results, and that occurred over the course of 2 months. Risks. Maximum historical drawdown is 6.4% over 5 years, as we went through before. I just said 6.8%. Maximum drawdown cutoff is 30%. Absolutely unlikely. At 8%, the clients would be calling, asking what's happening. At 10%, we'd be shutting it down. That's a simple disclaimer, and we like to make all clients aware that we're dealing with, so that maximum cutoff there is 30%. We just like to put that in there. Highly unlikely it's ever going to occur. We like to make it very clear to all clients so they understand the risk of all products, or the worst case scenario when getting involved, and obviously allocating their hard-earned funds and resources to these products. So here is the drawdown table, and I just want to show it as a demonstration here of the risk and its drawdowns over the last 5 years. So $400. This is on a $10,000 account. Can I point out? 400 seems to be the max that really occurs for the bulk of the time. 200 is the average drawdown on 10,000 here, so 2%, extremely light. The max we built into there was at 6.4%. So that took place over a couple of months in 2013. and it happens very slowly. It's not one trade. It's going to take weeks and months in order to build into these larger loss periods. Allocation. This is a general rule. IFM does not give general or personal advice in respect to personal portfolio allocation. Consider this presentation as a guide, as I went through before. These are some of the things we have available to clients. We have other things also, such as covered calls, futures, option strategy, etc. These are some structured ones we can offer. It's best to speak with your accountant or your financial advisor to have a chat, as they're a little bit more informed of your personal situation and are qualified to offer that advice. Here's the general rule. Here at IFM, we aim to balance risk versus reward by adjusting the percentage of each product in our client's portfolio with us according to the investor's risk tolerance, goals, and investment time frame. For our 3 cornerstone products, we suggest the following as a basic rule for a balanced approach. 60% equities geared towards longer-term outcomes. 30% Olympus trading a low-leverage directional FX strategy. 10% iGrid counter-trend strategy, which is aggressive in both risk and reward. So you can really see, we're trying to really push the idea and the notion that the safest money, if you look at the risk and reward, the smarter money is in equities because we're holding a tangible asset here that most likely, based on probability, will give us a more balanced return longer term. It's unleveraged. And we don't see those extreme movements, generally speaking, in equity markets that we do see in, say, an FX market, and especially a leveraged FX product. So 60% into equities, 30% into Olympus, 10% into iGrid counter trend, which, as I said, shouldn't be sold as an investment product, as it's aggressive in both risk and reward. And we went through earlier of how you can manage that, removing profits periodically and making a small allocation towards that. So the IFM objectives, just to wind up here. Risk management and capital preservation are paramount. Number 1. Number 2 is making profits. Always keep that in mind. Keep your money safe whilst ensuring it is working hard when opportunities arise. A great example at the moment, we're using 80% of funds available within our equity strategy. When we get that pullback we're after, we'll apply the rest of those funds. If we need to stay in cash for certain periods of time, we stay in cash. Markets move in cycles, so we've built a portfolio of quantitative strategies with a goal to have our clients fully exposed to the right strategy for the right market, even if this means strongly weighted towards cash in tough markets, as I just discussed. That pretty well summarizes everything. So I've just given you 3 different ideas you could apply to portfolio. If you'd like to chat about any of these, give us a bell here on the desk. It's 1300-735-125. You've got our details. You can also reply to the email that will go out today with this webinar, and also a couple of brochures, which give you the overview of both Olympus and our equities portfolios. Here at IFM, we also cover covered calls, option strategies over both equities and futures contracts. Also, the futures could be agricultural indexes, metals, and so forth. If you'd like to know anything more about any of this, give us a call here on the desk and we can have a chat. Thanks a lot for sticking with me through this webinar, guys. Any information, give us a call. Otherwise, send us an email through to customer service. Thank you very much.